The debt storm is breaking. 5 red flags you cannot ignore in 2026. Welcome to Money and Power. The debt storm is no longer a distant threat. It's breaking quietly beneath the headlines, and most people won't realize what's happening until the consequences show up in their mortgages, their savings, or their pensions. But you and I are not most people. We look beneath the surface at the pressures policymakers rarely discuss openly. Tonight, I want to walk through 5 red flags, signaling that the global financial system is entering a far more fragile phase as we move into 2026. This isn't hype or doom. It's a calm look at what is actually happening. Using real data, recent decisions by central banks, and the underlying structural shifts shaping our financial future. So let's begin. 1. The sovereign debt trap. When a country's biggest bill becomes the interest on its own debt, stability is already slipping away. The first red flag is the sheer scale and cost of sovereign debt, centered most visibly on the United States. As of late 2025, US federal debt has passed $38 trillion. But the more striking figure is this. In 2025, interest payments hit $1 trillion for the first time in history. That now makes interest the second largest federal expense, behind only Social Security. It is larger than the defense budget, larger than Medicare, and it is rising faster than tax revenues. This matters because a government drowning in interest payments becomes inflexible. It loses fiscal space, becomes slower to respond to crises, and increasingly relies on future borrowing just to service past borrowing. The Congressional Budget Office projects US debt held by the public will exceed 116% of GDP by 2034. When investors begin questioning whether a government can sustainably service its debt, risk gets repriced very quickly. And when you're dealing with the world's reserve currency, that repricing has global consequences. Red flag 2. Central bank liquidity and the QT backtrack. When central banks reverse course without warning, it usually means the system is under more strain than they admit. For several years, the Federal Reserve has attempted quantitative tightening, slowly shrinking its balance sheet. But in late 2025, a clear stress signal emerged. Banks began tapping the Fed's standing repo facility at record levels. This facility is meant to stabilize short-term funding markets, but heavy use tells us liquidity was becoming dangerously tight. Then came the big moment. In late November 25, the Fed announced it would end QT on December 1st. Months earlier than expected. This tells us 2 things. 1, the system cannot tolerate significant liquidity withdrawal. And 2, markets are now dependent on ongoing central bank support, far more than policymakers would like the public to believe. When liquidity tools intended for emergencies become permanent features, it is a sign the financial plumbing is more fragile than the headlines suggest. Red flag 3, the commercial real estate reckoning. Some crises explode overnight. Others quietly rot from within until the damage becomes impossible to ignore. The commercial real estate sector is one of those slow burn crises. Loans issued during the era of ultra-low interest rates are now becoming due in a high-rate world. Refinancing them is often unviable. Landlords face lower valuations, higher borrowing costs, and tenants who no longer need the same office footprint as before the pandemic. The result? Distress, especially in older, lower quality office buildings. Even though some analysts think activity may rebound slightly in 2026, the damage beneath the surface is significant. The institutions most exposed include regional banks and non-bank lenders, many of whom hold large portfolios of maturing CRE debt. When commercial real estate cracks widen, they spread through balance sheets, credit markets, and eventually the broader economy. This is the classic hidden injury, slow, quiet, but deeply consequential. Red flag 4, fragmentation of global trade. When the world stops trading smoothly, inflation stops behaving predictably, and growth begins to stall. Red flag 4 is the fragmentation of global trade, the steady unravelling of the post-war economic consensus. We're now living through an era of deglobalization. Tariffs returning, supply chains being reshored or friendshored, geopolitical tensions raising costs, and multinational CEOs delaying investment because the rules are no longer predictable. Around 70% of real estate industry leaders now cite deglobalization as a top concern, more than double compared to a year earlier. UNCTAD, UNCTAD, expects global growth to average just 2.6% through 2026. Not recessionary, but far below historic norms. This matters because fragmented trade leads to persistent inflationary pressure, especially in essential sectors like energy, food, and manufacturing inputs. It also undermines confidence. Markets struggle to price long-term risk when rules are constantly shifting. Fragmentation doesn't cause a crisis overnight, but it slowly removes the buffers that once kept the global economy stable. Red flag 5. K-shaped fragility and corporate stress. When the top of the economy thrives and the bottom weakens, the entire system becomes vulnerable to even a small shock. So this final red flag is the K-shaped nature of the economy. On paper, things look stable. Markets are calm, corporate credit appears manageable, and many forecasts predict steady, if modest, growth in 2026. But beneath the surface, stress is accumulating. Moody's projects speculative-grade corporate defaults could reach up to 8.3% through October 2026, an elevated risk band. Highly leveraged companies are facing margin compression. Some sectors are already struggling simply to roll over their existing debt. This fragility is mirrored in the consumer economy. The top 10% of earners continue spending, keeping headline numbers afloat. But the bottom 60% are straining under the cost of living, rising debt payments, and limited wage growth. An economy without broad-based strength is an economy vulnerable to shocks. A sharp move in energy prices, a geopolitical escalation, or even a correction in AI-linked technology stocks could disproportionately hit the lower half of the economy, and then cascade upwards through credit markets. So these 5 red flags, the sovereign debt trap, liquidity strain, commercial real estate stress, broken trade flows, and K-shaped fragility, tell us the financial system is walking a narrow path heading into 2026. For ordinary savers, the margins for error are shrinking. This is the moment to understand your exposures, to position carefully, and stay alert to what institutions are doing long before the headlines catch up. Now, if you find this kind of calm, clear analysis useful, please take a moment to like the video, subscribe to the channel, and tap the notification bell so you never miss an update. And let me know in the comments below which of these 5 red flags concerns you the most and why. Your thoughts genuinely help shape future videos. I look forward to seeing you at the next one.